On the evening of January 18th, 2026, while global markets appeared calm and mainstream media attention drifted toward diplomatic theater, a structural fracture quietly formed inside the global silver market. What unfolded was not a speculative event, nor a demand-driven rally, but the creation of a physical liquidity trap, one capable of disabling the geographic arbitrage mechanisms that underpin global price discovery. This article examines how a newly announced tariff regime, initially set at 10% and escalating to 25%, has introduced a one-way valve into the physical silver market, effectively trapping metal within United States borders, while starving the London Bullion Market Association, LBMA, of deliverable supply. The consequences extend far beyond price volatility. At risk is the integrity of the global silver pricing mechanism itself. This is not a story about inflation, currency debasement, or investor sentiment. It is a story about logistics, policy, and the fragile infrastructure that allows physical commodities to circulate between financial centers. When that infrastructure fails, price becomes a secondary variable. 1. The illusion of calm. Financial markets are rarely destabilized during moments of heightened attention. They fracture during silence. On Sunday evening, January 18th, 2026, silver traded just under $90 per ounce. Yet beneath this placid surface, the physical silver market was already seizing up. The reason was timing. A tariff announcement, released after London markets had closed for the weekend, fundamentally altered the economics of transatlantic silver movement. While traders, journalists, and policymakers debated geopolitics and diplomacy, the mechanical reality of silver transport was quietly rendered uneconomic. Markets price narratives quickly. They price plumbing slowly. 2. Silver's unique role in the financial system. Silver occupies a paradoxical position within the global financial architecture. Unlike gold, it is not primarily a monetary reserve. Central banks do not hoard silver. Sovereign wealth funds do not anchor currencies to it. Yet silver is everywhere. It is embedded in solar panels, semiconductors, medical devices, electric vehicles, defense systems, and telecommunications infrastructure. Its demand is industrial, continuous, and largely inelastic. Factories cannot wait out silver shortages. Production lines do not pause for price corrections. This dual identity, part precious metal, part industrial necessity, makes silver uniquely vulnerable to supply chain disruptions. When physical flow breaks down, there's no central authority capable of backstopping the market with emergency reserves. Gold has lenders of last resort. Silver does not. 3. The paper market versus the physical market. To understand the significance of the current disruption, one must first understand how silver is priced. The price most market participants see, the number scrolling across a trading screen, is not the price of a bar of silver. It is the price of a derivative. Specifically, it is the price of a futures contract settled through an exchange system that assumes continuous physical availability. The paper market functions smoothly as long as 3 conditions hold. Physical silver exists in sufficient quantity, that silver can move freely between global hubs. Arbitrage mechanisms remain economically viable. Remove any one of these conditions, and the system begins to degrade. The newly announced tariff regime directly compromises the 3rd condition. 4. The London-New York axis. For decades, the global silver market has relied on a silent partnership between 2 dominant hubs, London and New York. London, LBMA, functions as the epicenter of global spot pricing and unallocated silver trading. New York, COMEX, serves as the primary futures exchange and physical delivery point for North American markets. The system works because silver can move between these hubs with relative ease. When London inventories tighten, metal is shipped from New York. When New York faces pressure, supply flows from Europe or Asia. This geographic arbitrage is not optional, it is foundational. 5. The front-running of 2028. In early 2025, bullion banks anticipated potential import restrictions tied to a Section 232 national security review. Silver, classified as a strategic material due to its industrial applications, was widely expected to fall under scrutiny. Banks responded rationally. They repositioned physical inventory. Dozens of millions of ounces were transferred from LBMA vaults in London to COMEX-approved warehouses in the United States. This was one of the largest quarterly movements of silver between the 2 hubs in modern history. At the time, the strategy appeared sound. If imports were restricted, holding metal domestically would ensure delivery capability. What the banks failed to anticipate was directionality. 6. The one-way valve. The tariff announcement did not merely raise costs, it altered incentives. Under the new framework, imports into the United States face a 10% tariff beginning February 1st, 2026. That tariff escalates to 25% if negotiations fail by June 1st. Crucially, the policy applies to all goods, including silver, and explicitly names the United Kingdom. The result is a one-way valve. Silver can leave the United States without penalty, but once it does, returning it becomes prohibitively expensive. A bullion bank shipping metal from New York to London risks permanently impairing the economic value of that inventory. Rational actors do not volunteer for irreversible losses. 7. The geographic arbitrage trap. A geographic arbitrage trap occurs when the cost of moving an asset between markets exceeds the price differential between those markets. In silver's case, the math is unforgiving. At $90 per ounce, a 10% tariff adds $9 per ounce, a 25% tariff adds $22.50 per ounce. For arbitrage to function, London prices must exceed New York prices by more than the tariff cost. Until that threshold is crossed, physical flow stalls. This creates two prices, a domestically trapped US price, a supply-starved London price. When these prices decouple, global price discovery fails. 8. Why this is structurally different. Previous silver squeezes were demand-driven. Investors piled in, banks responded with paper supply, leasing, and inventory transfers. This event is supply-driven. No amount of short selling can create physical silver. No derivative can replace a missing shipment. When logistics fail, financial engineering becomes irrelevant. The tariff regime has removed the bank's most powerful release valve, geographic flexibility. 9. Early warning signals. While futures prices may remain deceptively calm, stress is already visible in the physical market. Bid-ask spreads are widening. Dealers are extending delivery timelines. Exchange for physical, EFP, spreads are growing. These are leading indicators. Price charts are lagging indicators. By the time the chart reflects reality, the structural break has already occurred. 10. What comes next? If the tariff remains in place, the market enters a countdown. 14 days for inventories to be repositioned. 14 days for London to source metal. 14 days for negotiations to either succeed or fail. After that, the system must adapt. It will do so through higher prices, rule changes, or failure declarations. None of these outcomes preserve the status quo. 36. The forward outlook. Probabilities, not predictions. Markets operate on probabilities, not certainties. In the case of the silver tariff disruption, the probability matrix is unprecedented. Optimistic outcome, turn 20%. Negotiations succeed, tariffs remain temporary, and geographic flow resumes within weeks. Neutral outcome, I just down 50%. Partial supply restoration arbitrage, resumes slowly, two price markets persist for months. Adverse outcome, down 30%. Tariffs persist, industrial demand continues, and the two-price system solidifies into a long-term structural premium. This framework demonstrates why traditional technical analysis fails. Price charts reflect past transactions, not future physical scarcity. 37. Greenland. Variable, geopolitics as a hidden force. A critical, often overlooked factor is Greenland, due to its rare earth mining and industrial silver exposure. Greenland exports refined silver intermediates essential to European manufacturing. Geopolitical tensions in the Arctic and regional trade regulations amplify risk. Any disruption in Greenland's production or export channels compounds the US-London arbitrage stress. Effectively, Greenland represents a hidden lever in the global supply chain that could accelerate divergence between paper and physical prices. 38. Scenario modeling. Time as a risk factor. We can model time as a variable in structural silver risk. Days from tariff implementation. Risk of structural price divergence notes 0, 14. Low moderate markets adapt gradually, 15 to 30 moderate high arbitrage stalls. Industrial demand persists, 31 to I60. High two-price system emerges. Banks begin invoking risk protocol 60 plus, very high. Long-term systemic premium, market fracturing possible. Time is the silent multiplier. The longer the tariff persists, the less likely spontaneous market correction becomes. 39. Institutional risk loops. Three interacting forces create systemic loops. Policy friction. Tariffs prevent efficient arbitrage. Industrial inelasticity. Production demand continues despite scarcity. Bank conservatism. Custodians protect capital, hoarding metal internally. Combined, these loops amplify structural premiums and destabilize the global price discovery mechanism. 40. Investor. Takeaways? Clarity over speculation. Investors must distinguish structural signals from short-term price noise, paper price volatility, physical scarcity, futures, liquidity, delivery certainty. Arbitrage spread widening is a leading indicator of supply stress. Ignoring these signals risks being blindsided by a rapid structural correction once arbitrage resumes or supply shocks materialize. 41. The countdown intensifies. The physical silver market now functions like a ticking clock. T, or around 0, tariff announcement, already passed. T plus 14 days. Initial implementation, T plus 60 days. Structural fragmentation, likely. Each day reinforces constraints. forcing industrial buyers, banks, and arbitrageurs to adapt or accumulate losses. 42. Strategic market adjustments. Banks and industrial actors will employ several strategies to cope, hedging via alternative metals, substituting or partially replacing silver where feasible, securing long-term contracts, locking supply months in advance to mitigate risk, regional sourcing adjustments, diversifying suppliers to reduce dependency on U.S. London flows, policy engagement, lobbying or negotiating tariff exemptions for industrial imports. Each measure alleviates part of the risk, but none fully restores global flow to pre-tariff equilibrium. 43. The human element, decision-making under pressure. Beyond mathematics, market stress tests, human decision-making. Treasury officials weigh geopolitical impact versus economic cost. Bullion banks calculate risk tolerance versus reputational exposure. Industrial procurement teams must act immediately to avoid production losses. Behavior under stress often accelerates structural outcomes faster than policy or pricing signals alone. 44. Lessons for modern commodities. This event highlights broader lessons. Paper markets cannot substitute for physical availability. Policy-induced friction can fragment global markets quickly. Industrial demand drives risk independently of financial speculation. Geopolitical hidden variables can tip markets even if mainstream attention is absent. These principles extend beyond silver to other critical commodities, including rare earths, lithium, and palladium. 45. Conclusion. Markets at a crossroads. The global silver market now exists at a fragile intersection of policy, industrial demand, and institutional conservatism. Prices are no longer solely determined by supply and demand charts. Physical scarcity and tariff friction dominate dynamics. A two-price world may emerge, with U.S. inventories isolated and global markets experiencing elevated premiums. Investors, analysts, and policymakers must recognize structural risk over speculative signals. Only then can they navigate the silent storm before the market fractures. The lesson is clear. Markets are calm until plumbing fails, and when it does, even decades of stability cannot prevent structural upheaval. 46. Final takeaways. Structural risks often accumulate quietly. Mainstream headlines rarely capture them. Physical silver scarcity, combined with tariffs, inelastic industrial demand, and conservative banking behavior, creates unprecedented market stress. Time magnifies risk. The longer constraints persist, the greater the divergence between paper and physical markets. Forward-looking analysis and proactive decision-making are essential for navigating this disruption. The silver market may appear calm today, but the structural forces at play suggest that future pricing and delivery realities will be radically different from past norms. 23. Industrial demand. The inelastic force. Unlike retail or speculative investors, industrial consumers cannot pause production in response to rising silver prices. Factories producing solar panels, semiconductors, medical devices, and electric vehicles require continuous silver supply. Delays are costly and often irreversible. Semiconductor fabrication plants may lose billions if a silver-based photomask fails. Solar panel manufacturers risk missing government subsidies and contracts. Defense contractors face compliance violations if silver-based components are delayed. This inelastic demand means that physical silver is being pulled into critical industrial channels regardless of price, further straining delivery systems. 24. When supply cannot meet demand. Under the tariff regime, inventories cannot flow freely between hubs. Physical silver in U.S. vaults is effectively trapped until tariffs are resolved. Meanwhile, industrial demand in Europe and Asia continues uninterrupted. This imbalance produces premiums in European markets, delayed deliveries and extended timelines, rising pressure on exchange of physical mechanisms. Traders watching COMEX or LBMA charts may see only minor fluctuations. In reality, structural stress is accumulating invisibly. 25. Banks a hidden dilemma. Bullion banks are central to the silver market, providing liquidity, leasing, and settlement services. The tariff disruption presents them with three bad options. Sell at a loss release trapped silver to satisfy international demand, but incur tariffs or opportunity cost. Default or delay delivery. Trigger force majeure clauses, damaging reputation and client trust. Hold inventory. Preserve capital but worsened global imbalances, creating two-price fragmentation. No option preserves all objectives. This asymmetry is what makes the risk so structural and dangerous. 26. The emergence of a two-price world. When physical flow stalls, the silver market fractures into two semi-independent pricing zones. U.S. market. Physical silver remains trapped. Domestic prices lag rising global prices. European global market. Scarce metal commands a premium, with prices reflecting true delivery scarcity. This is no longer a paper problem. It is real, tangible, and measurable. Consequences include reduced arbitrage activity, divergent futures and spot prices, elevated spreads in industrial procurement. Effectively, the market begins operating as two semi-isolated systems, a situation unprecedented in modern silver trading. 27. Paper markets and illusionary liquidity. Futures and unallocated silver contracts continue to trade, creating the illusion of liquidity. Traders see volume and volatility and assume efficiency. Reality is different. Physical metal is constrained. Deliverable inventories shrink. Industrial buyers bypass paper markets. The futures market reflects confidence, not availability. When confidence falters, paper and physical prices realign abruptly and often violently. 28. Force majeure, the legal contingency. If tariffs persist and delivery obligations cannot be met, banks and exchanges may invoke force majeure clauses. These legal provisions allow temporary suspension of contracts during extraordinary circumstances. However, force majeure does not create metal. Industrial demand continues paper and physical markets diverge further. The invocation of these clauses is a sign of stress, not resolution. 29. Industrial buyers. Take control. As the physical market tightens, industrial consumers act proactively, lock in supply agreements at any premium, secure multi-month contracts to avoid disruption, shift sourcing to alternative suppliers or regions. These behaviors accelerate price divergence and reduce flexibility for bullion banks and exchanges. 30. Margin pressure and market psychology. Exchanges attempt to suppress volatility via margin hikes. Paper prices are temporarily stabilized, but stress accumulates silently. Leveraged traders are forced to liquidate positions. Futures contracts diverge from spot. Reality, confidence erodes incrementally. This silent buildup is far more dangerous than sudden spikes. By the time prices reflect physical scarcity, structural adjustments are costly and sudden. 31. Why the U.S. market becomes self-isolating. The tariff creates an economic barrier, effectively insulating U.S. metal from international arbitrage. Domestic demand is now largely met internally. International demand cannot access U.S. silver without paying prohibitive tariffs. Inventory remains trapped, compounding scarcity elsewhere. This self-isolation reinforces the two-price system and increases systemic risk. 32. Systemic risk beyond prices. This scenario demonstrates the fragility of the global silver system. Paper contracts no longer guarantee delivery. Industrial users face potential operational disruption. Banks face liquidity and reputational risk. The combination of tariff friction, physical scarcity, and inelastic demand produces a risk loop. Each factor amplifies the others. 33. The global ripple effect. Even though the US and European hubs dominate, secondary markets feel the stress. Asian markets face rising premiums for deliverable silver refiners. Experience delayed shipments and elevated costs. Emerging market industries dependent on silver imports must scramble for alternatives. The disruption is not localized, it is global. 34. Lessons from history. Past silver squeezes, such as the Hunt Brothers event, 1980, or short-term industrial disruptions, were mostly demand-driven and temporary. This current scenario is policy-driven, structural, and multi-jurisdictional. Tariffs restrict flow permanently or temporarily, depending on political outcomes. Physical inventories cannot adjust quickly. Industrial demand continues at pace, insensitive to financial signals. The combination produces a long-duration structural premium, unlike anything seen in modern markets. 11. When policy becomes physics. Markets can negotiate with narratives. They cannot negotiate with mathematics. The moment the tariff framework was announced, the silver market crossed a threshold where policy ceased to be theoretical and became mechanical. From that point forward, the system was governed not by sentiment or expectations, but by arithmetic. In commodity markets, arithmetic is unforgiving. A 10% tariff is not a talking point. It is a line item. A 25% tariff is not a threat. It is a barrier. Once imposed, these numbers embed themselves into every decision made by refiners, shippers, vault operators, and bullion banks. And unlike monetary policy or forward guidance, tariffs cannot be arbitraged away. 12. The break-even equation. Let us strip away the rhetoric and examine the core calculation that now governs global silver flow. Assume the following baseline. Spot silver price, $90 per ounce. Shipping, insurance, and handling costs, $1 to $2 per ounce. Conservative estimate. Tariff, 10% initially, escalating to 25% under the 10%. Tariff cost, $9 per ounce. Total friction cost, tariff plus logistics, $11 per ounce. For a bullion bank to profitably move silver into the United States, the foreign price must exceed the U.S. price by more than $11. This immediately establishes a hard floor under U.S. physical silver prices. Domestic metal cannot fall below global prices minus the tariff cost or arbitrage would trigger. Under the 25% tariff cost, $22.50 per ounce. Total friction cost, $24.25 per ounce. At this point, arbitrage ceases to be a market mechanism and becomes a fantasy. A London price of 110 does not justify shipping silver back into the United States if the U.S. price is $90. The trade remains unprofitable. The global silver market does not equilibrate. It fragments. 13. Why $112 is not a price target. One of the most misunderstood aspects of this scenario is the emergence of the $112 to $115 range as a critical threshold. This number is not speculative. It is not aspirational. It is not a bullish projection. It is a break-even price. At a spot price of $89.94, a 25% tariff requires silver to trade above $112 before physical flow from U.S. vaults to international markets becomes economically rational. Below that level, metal remains trapped. Above it, flow resumes, but only reluctantly and only at extreme margins. This distinction matters because it reframes the entire discussion. Prices above $100 are not indicative of excess demand. They are evidence of system failure. 14. Inventory is not liquidity. One of the most common misconceptions in commodity markets is the belief that inventory equals availability. It does not. COMEX warehouse reports may show millions of ounces of silver, yet that metal is only liquid if its owners are willing to part with it at prevailing prices and if replacing it does not impose a structural loss. Under the tariff regime, replacement becomes punitive. Every ounce that leaves a U.S. vault risks becoming permanently impaired. To replace it requires importing silver at a 10-25% premium. Rational custodians respond accordingly. Registered inventory stagnates. Eligible inventory is quietly reclassified. Physical metal is withdrawn from delivery pools. This is not hoarding. It is capital preservation. 15. The behavior of smart money. Markets telegraph stress through behavior long before price reflects it. In the days following the announcement, registered silver stopped declining. Physical outflows slowed abruptly. Lease rates began to tighten. Dealers widened spreads. These are not coincidences. They are defensive maneuvers. Smart money does not chase price. It protects optionality. By refusing to sell into an uncertain replacement environment, institutional holders are forcing the burden of adjustment onto the market itself. 16. The illusion of rule changes. Skeptics often point to the exchange's ability to change rules as a pressure release valve. Margin hikes, delivery adjustments, cash settlement allowances. These tools are effective against speculative demand. They are powerless against logistical failure. Changing the rules does not move a bar of silver from New York to London. It does not satisfy an industrial user's production schedule. It does not create metal where none is accessible. At best, rule changes buy time. At worst, they destroy confidence. 17. Exchange for physical, EFP, the canary. The exchange for physical mechanism allows futures contracts to be converted into physical delivery via over-the-counter settlement. Under normal conditions, the EFP spread is negligible. When physical tightness emerges, the spread widens. A $1 spread is concerning. A $2 spread is alarming. A $5 spread is existential. At that point, the futures market is no longer pricing silver, it is pricing hope. 18. Margin hikes. As suppression. When exchanges sense instability, they raise margin requirements. Officially, this is risk management. Functionally, it is suppression. Margin hikes force leverage traders to liquidate, driving paper prices lower even as physical demand intensifies. This divergence creates the illusion of stability while pressure builds underneath. It is a familiar tactic. It is also a sign of fear. 19. Why London is vulnerable. The LBMA operates on unallocated silver. This system functions as long as confidence remains intact and physical availability is assumed. When physical sourcing becomes constrained, unallocated markets face a credibility crisis. London cannot print silver. It cannot tariff its way out of shortages. It cannot compel U.S. vaults to ship metal at a loss. Its leverage is reputation, and reputation erodes quickly when delivery timelines slip. 20. The countdown effect. Time is now a variable. Every day without a resolution tightens the trap. February 1st activates the 10% tariff. June 1st threatens escalation to 25%. Inventories remain static. Industrial demand continues uninterrupted. Markets can ignore risk briefly. They cannot ignore deadlines. 21. The false comfort of headlines. Mainstream coverage frames the tariff as a negotiating tactic. Markets often mistake intent for outcome. Negotiations fail. Timelines expire. Policies harden. The silver market does not require malice to break. It requires only inertia. 22. The point of no return. Once physical prices diverge meaningfully between hubs, trust fractures, traders stop assuming fungibility, hedgers stop relying on futures, industrial users bypass exchanges entirely. At that stage, the market no longer corrects itself, it reorganizes,